Welcome to today's accounting and finance quiz. We're going to look at the CVP analysis, and we're also going to look at cost allocation, cost rates. If you're ready, I am. Question number 1. Which of the following formulas correctly calculates the break-even point in units for cost volume profit CVP analysis? So option A says total fixed cost divided by contribution margin ratio. Option B says total fixed cost divided by contribution margin per unit. Option C, total fixed cost plus target profit divided by contribution margin ratio. And D says total variable cost divided by contribution margin per unit. So which is the correct answer? Is it A? Is it B? Is it C? Is it D? What is your answer? No cheating. Okay. So go in. I taught this before. If you've not watched the video, I encourage you to go back and watch it before you come and take the quiz. It's easy peasy. So the correct answer to calculate the break-even point in units, it is simply the total fixed cost divided by contribution per unit. So what is that? The correct answer, we have A, total fixed cost divided by contribution margin ratio. No. B, total fixed cost divided by contribution margin per unit. So the correct answer is B. Did you get that correctly? No cheating. Mark yourself. If you got it, give yourself 1 mark. Good. Let's move to question 2. Question 2 says a company X has fixed cost $60,000. That's our fixed cost. Total fixed cost is $60,000. A selling price of $20 per unit and a variable cost of 12 naira per unit. What is the break-even point in dollar sales? So if you've not watched the video, go back, watch it, come back and attempt this. This is very easy if you've watched the video. I did a video on it already. You can watch it here. Just go back and watch it and then come back. But if you already know it, then make your attempt and then tell me if you're correct. Drop your answer in the comment section. So is it A? A says $150,000, B says $100,000, C says $75,000, and D $60,000. Okay, so let's do it. You can see this. The first thing is your total fixed cost, which is $60,000. It is simply your total fixed cost divided by the contribution margin ratio. Now, when you are looking at contribution in units, it is total fixed cost divided by contribution per unit. But if you are looking for the dollar sales or the naira sales, the equivalent in value, that's in revenue, then you divide by contribution margin ratio. And what is the contribution margin ratio? So in this example, we're going to see SP is equal to, that's selling price, is equal to 20, variable cost is equal to 12, that will give us 8 as the contribution per unit. That's contribution per unit. But to get the contribution margin ratio, this is contribution margin. Contribution margin ratio is selling price minus variable cost divided by selling price. So you have 8 divided by 20, which will give us 0.4 if you calculate it correctly. Look at it. Okay? That is, you say 20 into 8, it won't go, so you say 0 point, and then you add a 0. 20 into 80 will go 4 times, so that will give you 0.4. So now, if you say 60,000 divided by 0.4. What will it give us? 60,000 divided by 0.4, which will give us 150. So you see that? That will give us 150. This is in dollars. Now I want to show you another way of doing this. You could get the break-even point in units and multiply it by the selling price. You're also correct. So if we want to do that, we'll say 60,000 divided by 8 multiplied by selling price of 20. So if you do that, you'll also be correct. You can get it this way also. So it's either you say the total fixed cost divided by the contribution margin ratio, or you say the total fixed cost divided by the contribution per unit multiplied by the selling price. You'll get the same thing. So we've divided by the contribution margin ratio. We got 150,000. Let's try the other way. So that will be 60,000 divided by contribution per unit and multiplied by selling price. And that will give us 150. So you can see it's giving us the same $150,000. Irrespective of the method we use, we're getting $150,000. And that is option A. So option A is the correct answer, $150,000. So did you get that correctly? If you did, give yourself 1 mark. If you got the first one and you got this, it means you have 2 marks. Let's move to question number 3. A company that uses a single plant-wide, corporate-wide, that is, you can say plant-wide or you say corporate-wide. So a company that uses a single plant-wide overhead rate typically allocates overhead costs based on which assumption? A, every department consumes overhead resources in different proportions. B, all products consume overhead resources in a uniform relationship to a single activity base. C, non-manufacturing costs should be allocated alongside manufacturing costs. D, direct material costs is always the most accurate cost driver. So which is the correct one? Go in. I'm about to go. And gone. The correct answer is all products consume overhead resources in a uniform relationship to a single activity base. So why we use, or why a company will decide to use a corporate wide allocation rate to allocate its manufacturing overhead is because the production, all the departments, everything produced seems to be uniform. So to do that, they believe that one rate is enough to allocate and absorb the costs. So you can read up more about corporate wide rate. There's corporate wide rate, there's departmental rate, and there's also the activity-based costing method, which is said to be the most accurate. So when you use the corporate wide rate, it is usually because you believe that you have uniform production, everything about them, their cost drivers, everything is uniform. And it is very, very cheap. It's very cheap to maintain. So it is very convenient. But it is the least precise costing method. Let's move to question number 4. Question number 4 says, why will the manufacturing company switch from a corporate wide overhead rate to departmental overhead rate? I seem to have given out the answer in my explanation of number 3. Well, let's see how smart you are. If you listened, then you should have the answer from my explanation in number 3. So I take it again. It's a why will the manufacturing company switch from a corporate wide overhead rate to departmental overhead rate? Why would the company do that? I mean, the company was using corporate wide overhead. Why would they abandon it and switch to departmental overhead rate? Why would they do that? A says to decrease the total amount of manufacturing overhead costs incurred. B, to simplify the bookkeeping and cost allocation process. C, to better reflect the different levels of overhead resources consumed by various departments, and D, to eliminate the need for tracking direct labor hours entirely. So what's the correct answer? Going, and gone. The correct answer is simple. That should be that is C, to better reflect the different levels of overhead resources consumed. Yes, to better reflect the different levels of overhead resources consumed by various departments. So if you believe that the corporate-wide rate is not a good one, then you can move to departmental overhead rate, because you believe that it will better reflect the different levels of overhead resources consumed by various departments. So you move to departmental overhead rate method. So that's the answer. Let's move to number 5. Number 5, which of the following is a primary characteristic of activity-based costing, ABC? A, it uses a single volume-based cost driver for all organizational pools. B, it allocates non-manufacturing overhead but completely ignores manufacturing overhead. C, it assigns costs to activities first and then assigns activity costs to product. D, it relies exclusively on direct labor hours to allocate secondary facility costs. Which is the correct answer? Drop your answer in the comment section. I want to see it. I want to see if you're making progress or whether you're just filling all the questions. Even if you are, this should be an opportunity for you to learn it. I mean, if you failed, it is easier for you to know why you failed, so the answer sticks in your memory and you never forget it again. So don't cheat, just write the correct answer. I want to see it. Okay. So the answer is simple. It assigns, the answer is C, it assigns cost to activities first and then assigns activity cost to product. That is the activity-based costing. So we have the corporate-wide overhead rate, we have the departmental, and then we have the ABC, that's the activity-based costing. And the activity-based costing is the most precise because it is very thorough. It first of all assigns cost to all activities. When after pulling all the costs, then it begins to assign them to activity levels, activities. And then it gets to assign that activity cost to the facility cost. So the mistake is very, very minimal. That's the activity-based costing. There is no arbitrariness at all in activity-based costing, unlike the corporate-wide. The corporate-wide method just takes one rate and all costs, all the costs, you use it to allocate. So which is not correct at all, except where they are all uniform. We've explained that before. So let's move to question number 6. In an activity-based costing system, ABC, machine setup costs are most accurately classified into into which cost hierarchy level? In an activity-based costing system, machine setup costs are most accurately classified into which cost hierarchy level? A says unit level activity, B says batch level activity, C says product sustaining level activity, D says facility sustaining level activity. Which is the correct one? This is easy peasy. If you read it, watched our past videos. If not, you can go and watch. The correct answer is B, batch level activity. So that's very straightforward. So once, if you study activity-based costing system, everything that has to do with machine setup cost, it is most accurately classified into batch level activity. So we'll do a video on that to make it clearer. So let's go on with the quiz. Number 7. Under what condition will a corporate-wide overhead rate yield product costing results identical to a more complex activity-based costing system? So we have agreed that the corporate-wide is the simplest, is the cheapest, method and is the least precise. But we say the activity-based costing is the one that is the most precise because it takes more money and it follows due process to allocate costs. So under what situation will the one that is the cheapest and the least precise, under what condition will it be the same? That's the corporate-wide and the activity-based costing. Under what condition will they be the same? So A says when all products consume all activities in exactly the same proportion as the corporate-wide allocation base. B, when fixed costs make up less than 5% of the total product cost. C, when the company manufactures a high diverse mix of complex and simple products. C, when the company manufactures a highly diverse mix of complex and simple products. And D, when the manufacturing process is fully automated and uses no direct labor. Which is the correct answer? Waiting for you. What is the correct answer? Write it down in the comment section. I want to see it. Correct answer is A, which is straightforward. So when all products consume all activities in exactly the same proportion as the corporate-wide allocation base, then everything will be the same. So that's when it happens. Let's go to number 8. Product distortion, which is a situation where you undercost low-volume complex products and overcost high-volume standard products, is a common failure of which system? A, activity-based costing. B, departmental rates based on unique machine hours. C, corporate-wide rate based on direct labor hours. And D, multi-level cost hierarchy tracking. The correct answer is C, corporate-wide rate based on direct labor hours. Let me explain. Did you get it? Did you get it? No cheating. All right. Now, the corporate wide rate based on direct labor hours uses one rate to allocate all the costs, irrespective of the department, irrespective of what is produced. Let's say you have two, let me use this pen as an example. Let's say you have two pens. You have one that is a unique pen, okay? And you have your normal pens. Of course, because you are using one corporate wide rate to allocate costs, all the costs, manufacturing costs incurred, you will now start allocating them using a single rate. If you are using a single rate, it means both the designer pens and the ordinary pens, you are giving them the same rate. When you use the corporate wide rate, it means you will be undercosting low volume complex products, and then you are overcosting the high volume standard products. So the standard ones are just the ones they are just standard. You don't have extra work on them. But the ones that are unique are low volume, but they are complex. So it is because you are giving them the same rate. When you calculate your cost of production and put the price, you will be misled because you did not do your costing correctly. Let's go to number 9. If a company shifts from a traditional corporate-wide allocation base to ABC and discovers a product was previously heavily overcosted, what is the most likely consequence? A, the product's revised profit margin will look lower than before. B, management can confidently drop the product to save fixed overhead. C, the company may have been overpricing the product, losing market share to competitors. And D, total corporate fixed overhead expenses will instantly decline. What is the correct answer? Write it down in the comment section. I want to see it. No cheating. It's just a quiz. Now, the answer is C. And this is what it means. C says the company may have been overpricing the product, losing market share to competitors. Yes. So if you were using a rate which was very, very less precise, that's the corporate wide, using one rate to allocate all your manufacturing overheads, you know that it's not an accurate method at all. You are using one for all the departments, even though the products are not uniform. Maybe you have some designer pens and you have some standard pens, but you are using the same rate to allocate all the overhead costs. What it means is that because you are attaching the same production costs, the overhead costs that you are sharing, basically, you are allocating them in the same manner. Meanwhile, the cost of producing one is far lower compared to the other one, especially the one that is the designer. So it means that that one is supposed to take more, but because you are using one rate, it made you to overprice the standard product. You were overpricing it. They were supposed to go to the unique product, but because you are using one rate for all of them, you are sharing them equally. So what it means is that you were calculating the production cost wrongly, piling up costs on a product that did not cost you so much. And because of that, you know that it is after you have gotten your production cost that you add something up to get the selling price. So what this means is that you were overpricing a product. And when you overprice your product, I mean, the product did not cost so much, but you added so much on it, making you feel that you needed to still increase it more to make a profit. So by overpricing your product, you are scaring your customers away, and your competitors who were using ABC, activity-based costing, were getting the correct cost of their production and charging less. So most of your customers were running away from you and going to your competitors. This is what it means. Last question, number 10. A company has a machining department, allocates via machine hours, and an assembly department allocates via direct labor hours. Product Z requires 5 machine hours and 1 direct labor hour. If the machining rate is $10 per hour and the assembly rate is $15 per hour, what is the total allocated departmental overhead for product Z? A is $25, B is $50, C is $65, and D is $75. Let's do the calculation, simple calculation. So this is what we're going to do. You'll see we have 2 departments. We have machining, let's call machining M, and then let's call the other one, the other department, assembly, let's call it A. You see, these are the 2 departments. A company has a machining department, and what do they use? Machining uses machine hour, so let's put MH, and then assembly department uses labor, that is direct labor hour, so we say direct labor hour. This is what I've done. You can see it clearly. Next, let's put company Z by the side. This is company Z. They say it requires 5 machine hours, so we'll put machine hours 5, and assembly requires 1 direct, we'll put 1. This is it. You see it? Machine hours 5, direct labor 1 hour. Let's see what the costs. If the machining rate is 10 hours, so under machining we have 10, and under assembly we have $15. So $15 and $10. These are the rates. What is the total allocated? So it means under machining we have 5 times 10. 5 times 10. This will give us the dollar rate, the dollar amount. And here we have 15 times 1. So we have, that is 1 times $15. So what it means, 5 times 10 here will give us, 5 times 10 will give us $50 plus 15. So 50 plus 15 will give us $65. So do we have $65? Yes, we do. Of course we do. So that is option C. So option C is $65. So this is it. Very easy. All right, so we've come to the end of this quiz. If you enjoyed this quiz, I want you to subscribe to the Finance Simplifier. My name is Echela Okori. I want you to like, share this with someone, and continue to follow for more quizzes like this.